This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This is the fourth and final lecture going through chapter 13 of the free lecture notes for CIMA P2, and it's a little bit more about inflation. Now, not so much or very little in terms of calculations, but a couple of points that could be quite important. In the example we went through in the last lecture, which don't worry, I'm not going to repeat it all, but there was inflation, revenue, materials, labour were inflating. And the way we dealt with it, the way we normally deal with it, is we discounted the actual cash flows at the actual cost of capital. Let me write that down. We discount the actual cash flows, and the other word for actual cash flows is what we call the nominal cash flows. If you see any mention of nominal cash flows, it means the actual cash flows, which meant doing that inflating, and we discount at the actual, or the other word for it is nominal cost of capital. Now that's what we did in that example, and that's what we normally do. We get the actual cash flows, which means inflating them all where necessary, and we discounted the actual cost of money. Well, as I'm about to show you, in certain circumstances, we could get the same answer a slightly different way. And let me show you with a little example that you wouldn't actually be asked to do, but I need to show you this to then be able to explain exactly what I mean. Exercise 5, if you look at that, let me just quickly go through the numbers, it won't take long, and then I can hopefully explain what the important thing about inflation is. Exercise 5, a new machine will cost 120,000, is expected to last 3 years with no scrap value. Production will be 10,000 units a year. The selling price is 20 a unit. The variable production costs 14 a unit, and they're both quoted in current prices. They're both expected to inflate at 5% per annum, and the cost of capital is 15%. Well, it's a very short example deliberately, so be patient, it won't take a moment. But let's do it the way we just did in exercise 4 rather. So where are we with 3 years? 0, 1, 2, 3. The operating flows, we've got selling price, revenue, oh dear, what am I doing? The revenue, again, I'll do it in thousands, as I said before, so it's 10,000 at $20. But it's at current prices, so the first receipt in 1 year's time, there would be 1 year's inflation at 5%, which will give us, if I keep to thousands, it will give us an inflow of 210. It carries on inflating at 5%. So in 2 years' time, it'll be 221. And another 5% in 3 years' time, it'll be 232. I've also got production costs, variable costs. It's in right here, 14 a unit, so 10,000, 14 a unit. And because it's inflating at 5% and it's at current prices, in 1 year's time it'll be 5% higher. And so an actual cost of, I think, 147. I seem to have, there we are, 147. And if I carry on multiply by 1.05 to inflate, time 2, 154, and time 3, 162, giving a net operating flow 63, 67, and 70. I was saying, keep this really simple, so there's no tax, there's no working capital, no capital allowances. We've got the capital flow, the original cost, of how much is it? 120,000. And so the net cash flow each year $120, 63, 67, 70. And finally, I can discount. The cost of capital is 15%. And so for my discount factor tables, for 1 year 0.870, for 2 years 0.756, 3 years 0.658. Present values. $55, $51, 47, and net present value of 33. We accept. I appreciate, again, it's in thousands, but I said all that. Now that's the approach we took before. We've worked out the nominal, the actual cash flows. We've discounted at the nominal the actual cost of capital, and that's fine. And incidentally, I could have speeded up slightly in that because both selling price and costs inflated at the same rate of 5%, what I could have done, but don't worry about this, it would save a few seconds, I could have said that at current prices, the net revenue per unit is 20 minus 14, so $6 a unit. There were 10,000 units, and because the 6 is at current prices, first year inflate at 5%, multiply it by 1.05, and of course you come to the same figure. So I could have saved a second or two, purely because they were both inflating at the same rate. Now, nothing new there at all. That's just a simpler version of exercise 4. However, think about it. The net cash flow at current prices was 60,000 at current prices. And what have I done? We've been all the way through inflating at 5% each time. And then we've gone through discounting them all at 15% each time for 1 year, 2 year, 3 year. So every year we were effectively taking that 60,000 and every year we were increasing it by 5%. And to get the present value, we were then discounting it by 15%. So we're sort of adding on 5% each year and taking off 15% each year. Well, as I'm about to show you, we could in fact do the 2 steps in one. So instead of going all the way through and upping it by 5%, downing it by 15%, we could have put the two together. Let me show you. There's a formula. The formula is above the exercise. I'm still in red. Let's change it back. You've got a formula there, the Fisher equation, that 1 plus I is 1 plus R times 1 plus H, where I is the nominal or the actual cost of capital, R is what we call the real or effective cost of capital. I'll tell you why real afterwards. And where H is the inflation rate. And let's just look at that for our question. We know in our question what the actual cost of capital is. It's 15, was it? It's 15%. So 1 plus 15%, or 0.15, 1.15 equals 1 plus this real or effective cost of capital, which I'm going to explain shortly, times 1 plus the inflation rate. Here, the inflation rate throughout was 5%, so 1.05. And so, rearranging, 1 plus R equals 1.15 divided by 1.05 equals 1.0952, or R is 0.0952 or 9.52%. And as I'm about to show you, instead of the effect rather of inflating those current price flows at 5%, discounting them at 15%, the net effect, we could achieve the same result by discounting the current price flows at this real or effective rate. That the net effect of increasing at 5 and discounting at 15, the net effect, we get the same result discounting by a net 9.52. Now, discounting at 9.52 itself would be messy because the tables don't have 9.52% in it. You know, mentioned last chapter, I think it was. We can calculate a factor at any rate. But if you ever did need to do this, you'd be expected to use the tables and use it to the nearest percent. And that would make it a tiny bit quicker. Because think about it. This project, the cost was what? 120,000. Again, I want to work in thousands. The net inflow each year at current prices, so if we ignore inflation completely, remember the inflow each year, there were 10,000 units at a net selling price 20, cost 14, at a net $6 a unit. And so at current prices, ignoring inflation completely, that would be, if I keep in thousands, 60,000, 60 per annum. And it was for 3 years. So ignoring the inflation, here we happen to have a nice annuity. And if I discount them at the real or effective rate, now remember, strictly it should be 9.52 from the formula. I've already said, if you ever did need to do this in the exam, use the nearest table figure. So it's not going to be completely accurate, I hope you appreciate, but I'll do 10%. Well, 120 discounts to 120. The annuity, 3 years at 10%. We need our annuity tables. And for 3 years at 10, it's 2.487. And so the present value is 149. The net present value is 29. Now then, I did get 33 before, I now get 29. Please, please, I hope you appreciate, I hope you accept, I hope you believe me, that it's because strictly we should have done it at 9.52%. And so clearly doing it at 10% will end up giving a slightly different answer. If you don't believe me, then sit with your calculator, work out what the annuity factor is at 9.52%, and you will find you come to the same answer as we did before. Now fine, what's the relevance of that? The chances of being asked to do that that I've done on the screen are tiny. Because, of course, that only works because everything's inflating at the same rate. That wouldn't really be much help in example 4, which is more realistic, because in example 4 you'd got revenue inflating at one rate, you'd got materials inflating at another rate, you'd got labour inflating at a third rate. This only works, this idea of discounting the current price flows at the real effective rate. It only works if everything's inflating at the same rate. And so it's extremely unlikely you'll be required to do that. But you might well be required to need to use the formula. Because you see, even in example 4, where we were discounting the actual cash flows, the nominal cash flows, at the nominal, the actual cost of capital, well, we worked out the actual cash flows. We inflated. That's what I did in example 4. That's what I did in part A of this exercise. Here, I gave you the actual cost of capital was 15%. In exercise 4, you were told the actual cost of capital was 10%. But what you might be told is this. Suppose it said the real cost of capital is 8%. The general rate of inflation is 6%. If I've given it you that way, all right, you'll get your actual cash flows, you'll inflate all the individual flows at whatever the relevant inflation rate is. They won't all inflate at the same rate. But we then need to discount at the actual cost of capital. And how are we going to find out what it is? You'll use that Fisher formula again. Because we know that 1 plus the actual cost of capital is equal to 1 plus the real cost of capital, 8%, times 1 plus the inflation rate, 6%, which is 1.1448. That would be the actual cost of capital. Now, in the exam, you wouldn't be expected to discount at 14.48 and work out all the factors yourself. You'd write that down, but you'd then use the nearest rate from the tables, and you discount at 14. So that's what you need to be careful of. When there's inflation, almost always, you'll be discounting the actual cash flows at the actual cost of capital. If they give you the actual cost of capital, as we did in exercise 4, as we did in part A of exercise 5, no problem. But check carefully. If they ever tell you the real cost of capital, they'll also give you the general inflation rate. And you'll need to use the formula to work out the actual cost of capital and then discount at that rate. Last of all, part C. Why, in theory, will the decision remain the same whatever the actual rate of inflation turns out to be? Or why do we call it the real cost of capital? Well, the reason is this. We assume, and it does tend to be the case in real life, that as inflation goes up and down, so too does the rate of interest rates. Now, which cause, which effect, I don't care, but it does tend to be the case in the long term that as you've got higher inflation, you do have a higher rates of interest. As you have lower inflation, you have lower rates of interest. And so what this is really saying, you see, is that if the real cost of capital is 8%, they're saying, well, that's what the cost of capital would be, the interest rate, if there was no inflation. If there's inflation of 6%, the actual cost of capital will be higher. It'll be 14.48. If the rate of inflation was only 2%, then the actual cost of capital would be 1.08 times 1.02. 1.1016 or 10.16%. We're saying that in theory, cost of capital, interest and inflation rates go up and down together, and therefore if we discount the flows without inflation, the current price flows, if we discount them at the cost of capital without inflation, the real cost of capital, then it doesn't matter what the inflation is. If there's higher inflation, you have higher cash flows, but you have a higher cost of capital. They sort of cancel out. That's the theory behind it. But can I just stress what I said a moment ago? The reason it stands to matter to you, in virtually any exam question, you will do what we did in exercise 4, if I can find it. You'll discount the actual cash flows at the nominal cost of capital. So you'll go through and inflate the cash flows. You'll discount at the nominal cost of capital. Exercise 4. The one time this stands to be relevant is if they don't give you the nominal cost of capital, but they give you the real cost. Well, they'll have to give you the general inflation rate as well. You then need to be able to use the Fisher equation to work out what the actual cost of capital to use is. Right. Okay, well, that's the end of chapter 13. It's not quite the end of discounted cash flow, though. We've one more chapter where it's a couple of special situations that can occur. That'll be in the next lecture.